Somewhere in America today, a court clerk is stamping a stack of paperwork that initiates a legal process against thousands of people, most of whom don't even know it's happening yet. Data from the Consumer Financial Protection Bureau shows that roughly 1 in 7 American adults report having been sued by a debt collector at some point in their lives. This chart shows how debt collection has overtaken the civil court system. In the early 1990s, these cases made up roughly 1 in 9 civil filings. By the 2020s, in certain jurisdictions, that share has swollen to over 4 in 10. This is now the single largest, most repetitive category of litigation moving through American courtrooms every single year. Over 70% of these lawsuits end in a default judgment. This is an automatic legal win for the collector, entered by the court without a judge ever reviewing a single piece of actual evidence or hearing a trial. This is a forfeit. It is triggered by one specific failure. The person being sued didn't respond to the summons in time. Records covering hundreds of thousands of cases reveal a massive imbalance of power. Corporate plaintiffs are almost always represented by specialized firms filing thousands of cases a year. Meanwhile, fewer than 10% of the consumers being sued have any form of legal representation. The system functions as a corporate assembly line, where institutional experience faces off against individuals who often don't realize that ignoring the paperwork is the single most expensive mistake they could make. To see how this machine stays in motion, we have to follow the debt itself. By the time these cases reach a courtroom, the company suing is rarely the original bank where the debt started. When a consumer falls behind on a credit card or loan, usually for about 180 days, the original bank formally writes the debt off its books as a loss for tax purposes. That charge-off doesn't mean the debt vanishes. The bank packages thousands of these accounts into portfolios and sells them in bulk to third-party buyers. Portfolios sell for 2 to 4 cents on the dollar. A $5,000 balance costs just $100. Yet debt buyers sue for the full face value, plus fees, extracting thousands from an asset bought for pennies. There is a vulnerability. As debt is sold across multiple buyers over years, the paperwork rarely travels with it. Legally, this broken chain of title, missing contracts and histories, destroys the buyer's legal standing to sue you in court. Many of these lawsuits are not built on airtight evidence. They are statistical gambles that rely entirely on the consumer being too confused or intimidated to show up and demand proof. The outcome of almost every debt case in the country is decided by a single mechanic: the summons deadline. When formally served with a lawsuit, state law gives a strict window, typically 20 to 30 days, to file a document called an answer. This paperwork is the sole legal mechanism through which a defendant exercises their right to dispute a claim. If that deadline passes without an answer, the court automatically grants a default judgment, rubber stamping the debt without ever verifying if the balance is accurate. In California records, when a defendant filed an answer, the collector's win rate plummeted from over 70. When a consumer freezes and ignores the summons, the court treats that silence as a legal admission of guilt. Millions of automated lawsuits, accounts bought for pennies with missing proof, and an assembly line fueled by the failure to respond. A default judgment triggers the most aggressive phase of the entire process. With a judgment in hand, the collector gains the legal power to freeze bank accounts, place liens on property, and garnish up to 25% of a consumer's paycheck directly from their employer. Yet even at this stage, consumer protection laws provide specific counterweapons to challenge the judgment, vacate the ruling, and turn the tables on the collector. These powerful legal tools are exactly what the massive billion-dollar debt buyers pray the general public never discovers. Step 1 requires checking the expiration date on the debt itself. Every state enforces a statute of limitations, typically 3 to 6 years. Once that window passes, the debt becomes time-barred, meaning the collector legally loses the right to sue you. In the industry, this is known as zombie debt. Because junk debt buyers purchase these expired accounts for fractions of a penny, they will use aggressive tactics to convince you to make a tiny token payment, even just $5, by promising the phone calls will stop. Look closely at this timeline. Past the legal mark, it expires. But making a token payment or verbally acknowledging the debt restarts the statute of limitations clock from zero. That $5 payment just resurrected a legally dead obligation into a fully active lawsuit. Verifying exactly how old the debt is and refusing to hand over a single cent until you do is your absolute first line of defense against a predatory collector. If the debt is active and you choose to ignore the court summons, the court will automatically side with the collector by issuing a default judgment. Once that judgment is entered, the collection machine moves into the execution stage. The first tool they use is wage garnishment. On this mock pay stub, federal law lets collectors instruct employers to withhold up to 25% of disposable earnings, routing cash directly to the debt buyer. The second enforcement tool is a bank account levy. Armed with the judgment, a collector can legally instruct your bank to freeze and drain your checking and savings accounts, often with zero advance notice, stripping you of rent and grocery money. The third tool is a property lien. They can attach the judgment directly to real estate you own, legally preventing you from selling or refinancing your home until the debt, plus court fees and interest, is fully satisfied. These severe financial penalties happen automatically, but they can be completely stopped by taking one relatively simple administrative step: filing a formal legal response. The entire automated debt collection machine is designed to extract funds from undefended citizens. It relies entirely on your fear and silence to function. To disrupt the machine, you must file a document called an answer with your court clerk before the deadline printed on your summons. Filing this document activates a core legal principle known as the burden of proof. You do not have to prove that you don't owe the money. The debt buyer must affirmatively prove that you do. This checklist outlines exactly what they must verify with admissible evidence. First, that the debt actually exists. Second, that they legitimately own it through an unbroken chain of title. And third, that the balance they are demanding is mathematically accurate. The moment the court clerk logs your answer, the default judgment timeline is immediately halted. The collector can no longer win by default. By forcing the plaintiff to carry the burden of proof, you go from being an easy target in an automated system to a formidable legal opponent. Once your answer is filed, you gain access to discovery. This is a formal legal demand requiring the debt buyer to hand over their evidence. You will use this tool to demand 3 specific records: the original signed credit agreement, a full transaction history ledger, and the bill of sale tracing ownership from the original bank through every intermediate buyer. Here is the reality of the secondary credit market. Junk debt buyers purchase these portfolios for micro pennies on the dollar. Because of that, they rarely possess the original paperwork required to satisfy your discovery demand. While you are demanding their documentation, you should also audit their behavior using the Fair Debt Collection Practices Act, a federal law that regulates exactly how collectors can operate. The FDCPA strictly prohibits specific actions. Collectors cannot threaten you with arrest. They cannot misrepresent the amount you owe. And as you see here, they cannot call you before 8 a.m. or after 9 p.m. If you can document that a collector violated any of these rules, you can file a counterclaim against them for statutory damages. When you aggressively demand the original paperwork and introduce the threat of FDCPA counterclaims, the time and legal costs required to fight you quickly destroy the collector's profit margin, frequently forcing them to drop the lawsuit entirely. By verifying the statute of limitations, filing a timely answer, and demanding discovery, you strip the debt buyer of their ability to use the courts as an automated collection mill. Your immediate next step is to go online, search for your specific county court's answer to summons form, and file it before your legal deadline. If you have ever dealt with aggressive or misleading collection calls, tell us your story in the comments below. Sharing your experience can help another viewer recognize an illegal collection tactic today. If this breakdown helped you understand how to navigate consumer lawsuits, hit like, subscribe for weekly investigative finance exposés, and use these legal safeguards to dismantle predatory cases.